In the world of financial markets, silence is often the loudest warning. Right now, gold is not just sitting at a price level, it is holding its breath. Welcome to this comprehensive market analysis. Today, we are not just looking at a simple price forecast. We are going to dissect the anatomy of the gold market, XAUUSD. We are taking a deep dive into the technicals, the fundamentals, the Federal Reserve's dilemma, and the geopolitical chess game that is keeping the yellow metal supported. By the end of this video, you will understand exactly why the 143.89 US level is the key to the kingdom, why the upcoming NFP and CPI data could crash or rally the market, and how institutional investors are positioning themselves for value over momentum. Let's break down the chaos. Let's talk gold. First, let's strip away the news and look purely at price action. The article analyzing the current market state highlights a very specific technical phenomenon, the inside day. What does this mean? Imagine a spring being compressed. Yesterday, the market had a wide range. Today, the price is fluctuating entirely within yesterday's high and low. This signals indecision. It tells us that neither the bulls, the buyers, nor the bears, the sellers, are willing to commit massive capital yet. Currently, gold hovers near the pivotal $5,002.31 level. This isn't just a random number, it is a short-term 50% retracement level. In technical analysis, the 50% level is the battleground. If buyers can sustain the price above this level, they win control. If sellers push it below, they take the wheel. The bullish scenario? The forecast suggests that a sustained move over $5,231 indicates the presence of buyers. But where are they going? Their target is the Fibonacci level at 5,143.89. This is the breakout zone. If we see a daily close above $5,004, that creates a blue sky scenario where momentum traders will rush in, fearing they will miss the rally. The bearish scenario. On the flip side, a breakdown under $5,002.31 implies weakness. It doesn't necessarily mean a crash, but it means investors feel the current price is too expensive to buy without more proof. They want to build a stronger support base. This means price needs to go down to find liquidity before it can go up. The market is currently hesitating. Why? Because traders are looking for value, not just momentum. Momentum is chasing a price that is already running. Value is buying a price that is sitting still, waiting to be discovered. Right now, gold is sitting still. Technical analysis gives us the where, but fundamental analysis gives us the why. Why is gold hovering? Why isn't it crashing or soaring? The answer lies in two words: Fed policy. The entire global economy is currently playing a guessing game with the Federal Reserve. When will they cut interest rates? Gold is a non-yielding asset. It doesn't pay you interest like a bond or a savings account. When interest rates are high, gold becomes less attractive because it costs money to hold it, opportunity cost. When rates fall, gold shines. The current dilemma: the market is obsessed with the timeline. Will the first rate cut happen in March? Or will the Fed wait until June? Or the nightmare scenario for gold bulls, will they push it all the way to September? Our analysis points out that everything hinges on this week's data. Specifically, two major reports: Wednesday's non-farm payrolls, NFP, Friday's Consumer Price Index, CPI. These two reports are the judge and jury for the gold price. If the data comes in hot, meaning the economy is too strong and inflation is high, the Fed cannot cut rates. They have to keep rates higher for longer. That is bad for gold. If the data comes in soft or weak, meaning the economy is slowing down, the Fed will be forced to cut rates to save the economy. That is rocket fuel for gold. Let's drill down into the specifics. You cannot trade gold this week without understanding these numbers. Event 1, the non-farm payrolls, NFP. Gold traders are expecting the NFP report to show that the U.S. economy added roughly 70,000 jobs in January. This is the consensus. Scenario A, the steady or better number. If the report shows 70,000 or more jobs added, say 150,000 plus, this signals a robust economy. It tells the Fed, you don't need to cut rates in March. The economy is fine. Result, gold prices could sink. Why? Because the odds of a March or June rate cut will vanish. The market will price in a delay to September. The dollar will strengthen, and gold will drop below that $5,002 support. Scenario B, the big miss. If the report shows significantly fewer jobs, say 20,000 or negative growth, panic sets in. A weak labor market scares the Fed. Result, gold launches a rally. The narrative shifts immediately to, the economy is cracking, the Fed must cut rates now. Gold could smash through the $5,143 resistance in minutes. Event 2, the inflation monster, CPI. While Wednesday's NFP is the opening act, Friday's consumer inflation data is the main event. Inflation is the Fed's public enemy number one. Even if jobs are weak, if inflation remains high, the Fed is handcuffed. They cannot cut rates if prices are still rising. The bearish danger: if consumer inflation rises above expectations on Friday, it is a disaster for gold. It creates a scenario called stagflation concerns, but more immediately, it forces the Fed to be hawkish, aggressive. This conditions the market for a drop. The Goldilocks scenario, the ideal recipe. What is the perfect storm for a gold rally to $5,500 or beyond? The article outlines the ideal recipe. Weak jobs data, showing the economy needs help. Steady to lower CPI, showing inflation is under control. If we get this combination, the market will aggressively price in a March rate cut. The dollar will crash, yields will fall, and gold will be the only safe harbor. While traders obsess over the daily candles and US data, there is a massive silent force underneath the market that is preventing gold from crashing. We call this the fundamental floor. Even if US data is strong, why hasn't gold collapsed back to $4,000? 1. The China factor. A recent report highlighted in our analysis shows that China has been a net buyer of gold for 15 straight months. Think about the scale of that. The second largest economy in the world is relentlessly accumulating gold reserves. This creates a floor under the price. Every time gold dips, central banks, led by China, step in to buy the dip. They are diversifying away from the US dollar. This long-term accumulation is a structural bullish signal. It tells us that the smart money is thinking in decades, not days. 2. Geopolitical uncertainty. The geopolitical picture remains, as the report says, clouded with uncertainty. Whether it is tensions in the Middle East, Eastern Europe, or trade wars, uncertainty breeds fear. And fear is gold's best friend. The analysis suggests that this geopolitical tension might not be enough to trigger a massive breakout on its own right now, but it is certainly enough to provide underlying support. It acts as a safety net. Short sellers are terrified of holding short positions over the weekend because a single headline could spike gold $100 higher. To truly understand gold, you have to look outside of the gold chart. You have to look at the stock market. Traders are noting that improved risk appetite for global equities could be capping gains today. What does this mean? When investors feel safe, risk on, they buy stocks like the S&P 500 because stocks offer high returns and dividends. They sell safe assets like gold. When investors feel scared, risk off, they sell stocks and park their money in gold to protect it. Currently, the S&P 500 is performing well. Money is flowing into tech stocks and equities. This flow of capital away from safety is acting as a lid on gold prices. However, keep a close eye on the S&P 500 intraday. If the stock market starts to crack or sell off, that money needs a home. It will likely rotate into gold. The S&P 500 is your intraday catalyst. If stocks sneeze, gold catches a bid. Let's zoom out. Day trading is noise, trend trading is wealth. Technically, the long-term trend remains UP. We can confirm this by looking at the daily swing chart and the 50-day moving average, which is currently sitting down at $4,180 or $20. As long as the price is above this moving average, the bulls are in charge of the long-term narrative. The power of consolidation. The market has been consolidating in a wide range between $44.02 and $591. Many amateur traders get frustrated by consolidation. They call it choppy or boring. But the analysis provides a crucial piece of wisdom here. Holding inside the range is helping to create a solid support base. Why is this good for bulls? There is a trading maxim. The bigger the base, the higher in space. If a market spikes up rapidly, a spike bottom, it usually crashes just as fast because there is no support. But when a market grinds sideways, builds a floor, and exchanges hands at these levels, 5,000, it creates memory. It proves that the market accepts this price. A rally that launches from a solid base has durability. It is sustainable. Gold is currently doing the hard work of building a foundation so that when the rally to $5,500 or $6,000 happens, it holds. To the amateur, $5,143.89 is just a number. To the institutional algorithm, it is a mathematical wall. The article identifies this as a critical Fibonacci level. But why does this matter? We need to understand that modern markets are dominated by high-frequency trading, HFT bots and algorithms. These machines don't feel the market, they calculate it. They are programmed to take profits or initiate new positions at specific mathematical ratios found in nature, the Fibonacci sequence. The resistance level at $543.89 likely represents a key retracement level, possibly a 61.8% or a projection level. Here's the physics of the breakout mentioned in the forecast. Right now, sellers are defending this line. They have limit orders stacked at $5,143. Why? Because it's a safe place to sell based on past math. However, if the price breaks above this level, it does two things. It invalidates the bearish thesis. Every algorithm that was shorting gold will be forced to buy back their positions to cover their losses. This creates a short squeeze. It triggers momentum buying. Breakout traders sit on the sidelines waiting for this exact number. Once $5,144 prints on the tape, a flood of buy orders hits the market. This is why the article states that a move over this level could ignite a gold rally. It's not just about sentiment, it's about triggering a mechanical cascade of buying pressure. Until we cross $5,143.89, the bulls are in a cage. Once we cross it, the beast is released. One of the most profound insights in our analysis is this line. The overall hesitation could be an indication that investors are looking for value rather than momentum. Let's unpack this, because understanding this psychology is the difference between losing money and making a fortune. What is momentum trading? Momentum is chasing the train while it's moving. It asks buying gold when it asks already surging up $50 or $100 in a day. It feels good, but it's risky. You're buying expensive in the hopes it gets more expensive. What is value trading? Value is what the market is doing right now. Value investors do not chase. The fact that the market is hesitating and forming an inside day tells us that the smart money, the whales, the banks, are not interested in chasing price right now. They are waiting for the price to settle. They want to buy the dip, not the rip. This hesitation is a sign of maturity in the trend. If the market was weak, it would crash. If it was euphoric, it would skyrocket. The fact that it is holding steady tells us that the buyers are present, but they are disciplined. They are accumulating orders quietly at $5,002, building that solid base we discussed earlier. Let's go back to the macroeconomics. The article states, data could shift the next rate cut to March or September. This is the Fed pivot theory. For the last 2 years, the Federal Reserve has been hiking rates to fight inflation. Now we are at the top of the mountain. The next move is down, cutting rates. But timing is everything. The March cut scenario, the bullish dream. If NFP is weak, bad jobs, and CPI is low inflation, the market will scream for a March cut. Effect on gold. The US dollar index, DXY, will crash. Gold is priced in dollars. When the denominator dollar falls, the numerator gold rises. A March cut expectation pushes gold instantly towards that $5,143 breakout. The June-September delay, the bearish reality check. If the data this week is strong, the Fed will say, we can wait. Effect on gold. This introduces carry cost. Holding gold costs money, storage, insurance, opportunity cost. If rates stay high until September, traders will sell gold to buy bonds that pay 5% yield. This is why a steady or better jobs number could sink gold prices below $5,002. You are not just trading gold, you are trading the probability of the Fed's calendar. So how do we trade this? We don't guess, we react. Based on the technical parameters provided in the forecast, $5 pivot, $5,143 resistance, $44 support, here is the battle plan for the week. Strategy A, the bullish breakout, the momentum play. Condition, we need a confirmed daily close above $5,143.89. The trigger, a 4-hour candle closing above this Fibonacci level. The confirmation, weak NFP data or soft CPI. The trade, long positions. The logic, once the ceiling breaks, it becomes the floor. The inside day compression energy is released to the upside. Strategy B, the support bounce, the value play. Condition, price dips to the $5,002.31 level and holds. The trigger, a bullish candlestick pattern, like a hammer or engulfing bar, on the 1-hour chart touching $5,002. The trade, buy the dip with a tight stop loss just below $4,990. The logic, you are buying with the smart money who are defending this 50% retracement level. Strategy C, the bearish breakdown, the correction. Condition, a sustained move under $5,231. The meaning, as the article says, this means investors need to build a stronger support base. The target, if $5,002 fails, the door opens to the lower range boundary mentioned, $44,238. The trade, short positions below $5,000, targeting the liquidity pools lower down. The article gives us a cheat code for intraday direction, the S&P 500 index. We may have to focus on the S&P 500 index later today for an intraday catalyst. Why? Because flows are finite. There's only so much money in the world. If you see the S&P 500 rallying aggressively, risk on, expect gold to struggle or remain flat. Money is chasing stocks. However, if you see the S&P 500 hit a resistance wall and start to sell off, watch gold immediately. That money often rotates instantly into the safe haven of gold. The pro tip, don't just watch the gold chart. Keep the S&P 500 chart open on a second screen. If stocks dump, gold pumps. If stocks pump, gold lumps. Use the stock market as your leading indicator for gold's short-term momentum. The current market condition, this inside day and coiling, is not new. History rhymes. Let's look back at previous major gold rallies. Before gold broke $2,000 for the first time, what did it do? Did it go straight up? No, it coiled. It consolidated. It frustrated traders for weeks. It built a base. The article mentions that the market is consolidating inside a wide range, bordered by $400 and $50,91. This is classic Wyckoff accumulation. In Wyckoff theory, the market moves sideways to transfer assets from weak hands, impatient retail traders, to strong hands, institutions. The strong hands are buying that $5,002 level quietly. They want to bore you out of your position before the move happens. The current hesitation is not weakness, it is accumulation. The longer the market coils, the more explosive the breakout. The energy being stored between $5,002 and $5,140 is massive. When this spring uncoils, we aren't talking about a $50 move. We are talking about a trend that could last for months. We have talked about profits, but now we must talk about survival. The article warns of impending volatility due to NFP and CPI. Trading during these news events is like trying to pick up pennies in front of a steamroller. The golden rules for NFP week. Don't anticipate, participate. Do not place a trade before the number comes out guessing what it will be. That is gambling, not trading. Wait for the whipsaw. Often when NFP is released, gold will spike up $30, then crash down $50 in 1 minute. This is called a stop hunt. The market makers are clearing the board. The 15-minute rule. Wait 15 minutes after the data release. Let the amateurs get wiped out. Once the dust settles and the true direction is revealed, above 5,143 or below 502, then you enter. The goal this week is not just to make money. It is to ensure you still have an account next week. Let's pause the technical analysis for a moment and ask the elephant in the room question. Why are we talking about gold at $5,000 or $5,143? To the average person, these numbers seem high, but the article's forecast isn't just looking at charts. It is implicitly looking at the purchasing power of the currency itself. Gold is not just a trading vehicle, it is a barometer of fear regarding the fiat currency system. When we see price levels like $5,231 acting as a pivot, it reflects a repricing of the global financial system. The long-term bullish foundation mentioned in the report is built on one thing: debasement. Governments globally are running massive deficits. To pay for this, they issue debt. Eventually, central banks print money to buy that debt. More money, cars, less value per dollar. Less value per dollar, higher gold price. The hesitation we see in the market today, this inside day consolidation, is the market trying to calculate the rate of this debasement. If the Fed cuts rates, as discussed in the NFP section, they are essentially loosening financial conditions, which weakens the dollar. A weaker dollar is the rocket fuel that validates the $543 breakout. You aren't just buying gold, you are selling the dollar. The article provides a specific technical anchor that we cannot ignore. Technically, the trend is up according to the daily swing chart and the 50-day moving average at $45.80. Why is the 50-day moving average MA so important? In the world of institutional investing, the 50-day MA is the border between a correction and a bear market. Above the line, the asset is healthy. Dips are for buying. Below the line, the trend is broken. Dips are for selling. Currently, with gold hovering near $500, we are trading significantly above this $4,580 average. This tells us two things. Strength. The trend is powerfully bullish. The market is comfortable, trading nearly $400 above its average price over the last 50 days. Overextension risk. However, markets act like rubber bands. If price gets too far away from the average, it often snaps back. This explains the hesitation and the need to build a stronger support base. The market might be waiting for the 50-day MA to catch up to the price, or for price to drift sideways until they meet. The analysis drops a geopolitical bombshell. A recent report showed that China was still a buyer of gold in January for a 15th straight month. This is not normal behavior. This is strategic accumulation. Why is China buying gold every single month for over a year? It connects back to the geopolitical picture remains clouded with uncertainty. China is aggressively diversifying its reserves away from the US dollar and US Treasury bonds. They are swapping paper assets, which can be sanctioned or frozen, for hard assets, gold. What this means for your trade, this creates a central bank put option. Usually when gold prices get too high, demand drops, but right now we have a price-insensitive buyer. China and other central banks are buying regardless of the price. This is why the breakdown under 502 mentioned in the article is likely to be limited. If the price drops, China buys the dip. This underlying support prevents the market from crashing. Even if the NFP data is strong, the floor is solid because the whales are swimming beneath it. The article identifies the current setup as an inside day. Let's turn this into a specific trading lesson. An inside day represents a contraction of volatility. The market is coiled. Think of it like holding a beach ball underwater. You can hold it there for a while, but eventually it will shoot up, or if you puncture it, it sinks. How to trade the inside day breakout. The article gives us the levels. The range is likely defined by the previous day as high and low. The trap. Amateur traders try to trade inside the range. They get chopped up, they buy at 505 and get stopped out at 4,995. The professional approach. We wait for the breakout. We set entry orders above the mother candle's high, towards that 5 hour $142 target. We set entry orders below the mother candle's low. The forecast says a breakout above 50,143.89 could ignite a gold rally. This is the confirmation signal. The inside day tells us the energy is stored. The breakout tells us the direction of the release. Do not predict the direction. Let the market show you the path, then follow it. Buried in the report is a mention of another key data point. Today's retail sales. Why do gold traders care about retail sales? The U.S. economy is 70% driven by consumer spending. High retail sales. The consumer is spending money. The economy is hot. Inflation might rise. The Fed keeps rates high. Bad for gold. Low retail sales. The consumer is broke. Credit cards are maxed out. Recession is looming. The Fed must cut rates to save the consumer. Good for gold. The article notes that traders are looking for direction from these reports. If retail sales miss expectations, come in lower, it adds weight to the argument that the Fed must pivot to rate cuts sooner rather than later. This would support the value buyers stepping in at $5,002. It paints a picture of a slowing economy where gold becomes the ultimate hedge against recession. We discussed the NFP, jobs, and CPI, inflation, separately. But what if we combine them into the worst-case scenario? The article hints at this. Conditions could shift even more dramatically if consumer inflation rises and weak jobs data. Imagine this Wednesday, we get weak jobs. Economy is dying. And this Friday, we get high inflation. Prices are rising. This is called stagflation. It is the nightmare scenario for central banks. They can't raise rates because the economy is dying. They can't cut rates because inflation is high. They are trapped. In a stagflationary environment, stocks usually crash because earnings drop. Bonds crash because inflation eats yields. Where does the money go? Gold. Gold is historically the #1 performing asset during stagflation. Think of the 1970s. If this week's data points towards stagflation, the resistance at $5,143 won't just break. It will be obliterated. We could see a vertical move as institutional capital flees everything else to hide in gold. In the technical picture section, the article mentions its pivot is 4,700-4,715. This is a crucial level for longer-term swing traders. While day traders are watching $5,002, the $4,647 pivot is the gravitational center of this current market range, $44 to $50.91. Price tends to oscillate around the pivot. Currently, we are trading above the pivot, 5,002.4747. This confirms the bullish bias. If we were below 47.47, the bears would be in control. The fact that we are sustaining price action significantly above the pivot, 47.47, and the 50-day moving average, 45.80, reinforces the building a solid base narrative. The market is accepting higher valuations. It is not rejecting them. This suggests that the next major leg of the journey is up, not down. The article mentions we may have to focus on the S&P 500 index later today for an intraday catalyst. Let's get tactical. How do you use the S&P 500 to trade gold today? We are looking for correlation breaks. Normally, in a risk-on world, stocks go up and gold goes down or stays flat. However, pay attention to the opening bell of the New York session, 9:30 a.m. EST. Scenario 1, S&P 500 drops sharp 1% and gold jumps plus 0.5%. Analysis, fear trade, capital rotation. Buy gold. Scenario 2, S&P 500 rallies, plus 1%, and gold rallies, 1%. Analysis, the everything rally. The dollar is crashing, buy gold aggressively, this is the strongest signal. Scenario 3, S&P 500 rallies, forms 1%, and gold drops 1%. Analysis, standard risk on. The article warns, improved risk appetite could be capping gains. Stay away from gold longs. Use the S&P 500 as your windsock. It tells you which way the wind of capital is blowing before it hits the gold market. Let's circle back to the most philosophically important line in the forecast. Investors are looking for value rather than momentum. In the age of TikTok trading and 1,000% crypto gains, we have forgotten what value means. In the gold market, value is not just buying low, it is buying confirmation. The article suggests that the hesitation at $5,002 is investors asking, is gold worth $5,000? If the answer is no, we drop to $4,400 to find buyers. If the answer is yes, we blast through $5,143. The value opportunity here is the base building. When you see price consolidating for weeks or months, it is building energy. The longer it stays here, the more value is created. Why? Because the weak hands leave. The impatient traders exit. The only people left holding gold at $5,000 are the believers, the strong hands. This makes the eventual breakout incredibly powerful because there are no sellers left to block the path.